Imagine waking up one morning in 2026 to find your investments wiped out overnight, banks scrambling, and the global economy in free fall. That's the terrifying reality of the impending market clash everyone's whispering about, but no one dares to shout. This isn't just another dip. It's a colossal collision of economic forces brewing right now, as we speak, on 2026. Experts like Harry Dent are sounding the alarm, predicting a crash worse than 1929, with stock markets plummeting up to 80% in some sectors. Picture this: tech giants like Apple and Nvidia, once untouchable, crashing as Al hype bursts like a soap bubble. But why 2026? It all ties back to the lingering effects of post-pandemic inflation, skyrocketing debt levels hitting $35 trillion in the US alone, and geopolitical tensions escalating with trade wars between superpowers. Wall Street veterans are pointing to overvalued stocks, with the S&P 500 trading at unsustainable multiples, ready to snap under pressure. And don't forget the real estate bubble. Homes priced at record highs while interest rates flirt with hikes again. This clash isn't random. It's the result of years of reckless monetary policies, where central banks printed money like there's no tomorrow, inflating assets beyond reality. Viewers, if you're invested in stocks, crypto, or property, this video could save your portfolio. We'll dive deep into the signs, the culprits, and how to shield yourself. Stick around, because by the end, you'll know secrets the elite use to profit from chaos. Let's start with the historical parallels that make this clash inevitable. Back in 2008, we saw the housing market implode due to subprime loans wiping out trillions. Fast forward to today, and we're seeing similar red flags. Corporate debt at all-time highs. Consumer spending slowing as credit card defaults rise 20% year over year. Economists at Project Syndicate warn of turbulent asset markets, with volatility indexes spiking unpredictably. And Charles Schwab highlights 4 pitfalls: lingering economic cockroaches like unresolved supply chain issues, soft data filtering into spending habits, changing rate pictures hitting US assets, and more. But what makes 2026 unique? It's the convergence of AL overinvestment, climate-driven commodity shortages, and political instability post-elections. Reddit forums are buzzing with predictions. One user forecasts the highest crash potential this year due to over-leveraged positions. If history teaches us anything, it's that markets don't crash without warning. They whisper first. Listen closely. Bond yields inverting, insider selling at record paces, and hedge funds quietly shorting majors. The hidden triggers that could ignite it all. Let's uncover the hidden triggers of the 2026 market clash that mainstream media won't touch, because they're too busy pumping optimism to keep the masses invested. First off, inflation isn't dead, it's lurking like a predator. JP Morgan economists predict it surpassing 3% in 2026, eroding purchasing power and forcing the Fed to hike rates unexpectedly. Imagine your grocery bill doubling while wages stagnate. That's the reality hitting millions, leading to reduced consumer spending, the backbone of the economy at 70%. But wait, there's more. The debt time bomb. US national debt clocks in at over $35 trillion, with interest payments alone devouring budgets, leaving little for stimulus. Wall Street veteran warnings, like those in Investor Place, foresee a 20% average market loss, but blue chip stocks could tank 50% or more. What if I told you AL is the next dot-com bubble? Trillions poured into tech without real profits. Nvidia's valuation rivals entire countries, yet adoption lags. Geopolitics adds fuel. US-China trade clashes escalating, supply chains fracturing over chips and rare earths, pushing commodity prices sky high. Oil could hit $150 a barrel, if Middle East tensions flare, crippling transportation and manufacturing. And don't overlook crypto's role. Bitcoin's halving cycles often precede market downturns, with 2026 aligning perfectly for a bust. Reddit predictors see 2026 as peak crash risk due to overextended bull runs post-2020. Harry Dent's YouTube rants compare it to 1929, but worse, with demographics shifting, baby boomers retiring, selling assets en masse. This clash isn't just stocks. It's a systemic collision affecting bonds, forex, and even gold. Viewers, if your heart's racing, good. Knowledge is power. Next, we'll explore expert predictions that paint a vivid, terrifying future. Diving deeper into the expert arena, the 2026 market clash predictions are flooding in from top minds, and they're not pretty, but they're essential for anyone wanting to safeguard their wealth in this turbulent year. Harry Dent, founder of HS Dent, is screaming from the rooftops about a historic crash worse than 1929, driven by demographic cliffs and asset bubbles bursting simultaneously. He forecasts stocks dropping 80 to 90% in the worst cases, with real estate following suit as overbuilt markets collapse under weight of unsold inventory. Over on Project Syndicate, analysts expect volatile asset markets throughout 2026, with 3 years of stellar returns giving way to inevitable corrections. David Rosenberg joins the chorus, warning of serious downturns in interviews, citing overvaluation and policy missteps. Picture this: the S&P 500 up 200% since 2020 lows, retracing half that gain in months. That's what Wall Street vets, like those in Investor Place, are betting on. With bear markets nobody sees coming, except the prepared. Charles Schwab's report outlines 4 pitfalls: persistent economic bugs, consumer data softening, rate shifts pummeling assets, and global uncertainties. Reddit communities are abuzz, with users predicting 2026 as the crash pinnacle due to AL hype deflation and election aftershocks. Even Motley Fool pinpoints inflation as the likely culprit, with rates not cooling as hoped, squeezing margins across industries. These aren't fringe theories, they're backed by data. Inverted yield curves signaling recessions 100% accurately historically, now flashing red again. Geopolitical experts add layers. Trade wars clashing with supply shortages, potentially halting growth. But amid doom, opportunities lurk. Contrarian investors thrive in clashes. Indicators screaming warning right now. As we peel back layers of the 2026 market crash, let's zero in on the screaming economic indicators that are flashing danger signs louder than ever. Ignore them at your peril, viewers, because these metrics don't lie. Start with the yield curve inversion. It's been upside down since mid-2022, predicting recessions with eerie precision, and 2026 could be when it bites hard. Unemployment ticks up subtly, from 4% to potentially 6%, as tech layoffs cascade into broader sectors. Consumer confidence indexes are dipping, with surveys showing 60% of Americans worried about finances, curbing spending on big-ticket items. Debt-to-GDP ratios hit 130% in the US, unsustainable levels echoing pre-crash eras like 2008. What about corporate earnings? They're plateauing, with S&P companies reporting flat growth amid rising costs, a recipe for valuation crashes. Housing starts plummet 15% year over year, signaling real estate weakness while inventory piles up in hot markets. Inflation data from JP Morgan shows spikes above 3%, eroding real wages and forcing policy tightenings. Volatility measures like the VIX are creeping up, hinting at investor nerves fraying. Global PMIs slip below 50, indicating contractions in manufacturing worldwide, exacerbated by trade clashes. Crypto correlations tighten, with Bitcoin mirroring stock moves, amplifying losses. These indicators aren't isolated. They're colliding like tectonic plates, building pressure for a massive release. Unmasking the potential causes of the 2026 market clash reveals a web of interconnected threats that could detonate at any moment. Let's break them down to arm you with knowledge that could turn crisis into opportunity. Chief among them is persistent inflation, fueled by supply chain disruptions from geopolitical clashes, pushing costs up and central banks into hawkish stances. Over-leveraged corporations, burdened with cheap debt from low-rate eras, face refinancing at higher costs, leading to defaults. The ale bubble bursts as promised efficiencies fail to materialize, vaporizing trillions in market cap. Demographic shifts accelerate. Aging populations in developed nations liquidate assets for retirement, flooding markets with sellers. Geopolitical flashpoints like US-China tech wars disrupt global trade, spiking commodity prices and halting growth. Policy errors loom large. If the Fed misjudges rate cuts, it could spark runaway inflation or deflation. Climate events clash with economies, with extreme weather damaging infrastructure and agriculture, inflating food prices. Crypto volatility spills over, as regulatory clamps in 2026 trigger mass sell-offs. Overvaluation metrics scream bubble. Price-to-earnings ratios at 30x, far above historical averages. These causes aren't hypothetical. They're manifesting now, per experts like Dent and Rosenberg. But understanding them empowers preparation. We examine the devastating impact on stocks. The impact of the 2026 market clash on stocks promises to be brutal, reshaping portfolios and fortunes overnight. Buckle up as we forecast the carnage and hidden gems within. Tech-heavy indices like NASDAQ could plunge 50% as overhyping of AL and semiconductors meets reality checks. Blue chips aren't safe. Companies like Amazon and Microsoft, reliant on cloud growth, face slowdowns from corporate belt tightening. Small caps suffer most, with limited cash reserves, leading to bankruptcies spiking 30%. Dividend stocks, once havens, get hit if earnings crater, forcing payout cuts. Imagine your 401k halved. That's the reality for millions if the S&P drops 40% as predicted by Investor Place. Sector clashes. Energy soars on shortages, while consumer discretionary tanks on spending cuts. International stocks clash too, with emerging markets volatile from currency devaluations. ETFs amplify losses as leveraged products unwind rapidly. Historical parallels to 2000.com and 2008 financials suggest prolonged recoveries, taking years. Yet value stocks in defensive sectors like utilities could outperform. This clash redefines investing paradigms. Shifting gears to real estate's role next. Real estate stands at the epicenter of the 2026 market clash, with bubbles poised to pop and reshape housing landscapes. Here's the unvarnished truth to protect your biggest asset. Home prices, inflated 40% post-pandemic, could correct 20 to 30% in overbuilt areas like Florida and Texas. Mortgage rates climbing to 8% squeeze buyers, leading to foreclosures rising 25%. Commercial real estate clashes hard. Empty offices from remote work trends cause values to halve. Rental markets flood with supply, depressing yields for investors. Zillow and Redfin data show inventory surging, signaling seller panic. Coastal properties face climate risks, clashing with insurance hikes. Global clashes affect too. Foreign investment dries up amid economic woes. Yet affordable Midwest markets might stabilize faster. Analysts predict a balanced 2026 market, but not without pain. First, preparation means diversification beyond property. Arm yourself against the 2026 market clash with proven preparation strategies that turn potential disaster into wealth-building triumphs. Let's equip you now. Diversify portfolios. Allocate 30% to bonds and gold as hedges against stock volatility. Build cash reserves. Aim for 12 months expenses to capitalize on bargains. Short overvalued sectors via options, but cautiously to avoid losses. Rebalance regularly, trimming winners before the clash intensifies. Educate on value investing. Hunt undervalued assets post-crash, like Warren Buffett does. Consider alternative investments, farmland or art, for inflation protection. Monitor indicators weekly, exiting positions at warning signs. Network with experts. Join forums for real-time insights. Tax strategies. Harvest losses to offset gains. Preparation isn't fear, it's smart. Survival. Tactics follow. Survival strategies for the 2026 market clash go beyond basics, offering advanced tactics to not just endure, but thrive amid economic turmoil. Dive in for game-changing advice. Adopt contrarian thinking. Buy when blood's in the streets, targeting beaten-down quality stocks. Hedge with inverse ETFs to profit from downturns. Develop multiple income streams, side hustles immune to market swings. Reduce debt aggressively, prioritizing high-interest loans. Scenario plan. Simulate crash impacts on your finances. Stay informed via reliable sources, avoiding hype. Community building. Form investment groups for shared wisdom. Mental resilience. View clashes as cycles, not ends. Long-term vision. Crashes birth bull markets. These strategies empower. Wrapping up our deep dive into the 2026 market clash, remember, forewarned is forearmed. This could be the defining event of the decade, but with the insights shared, you're positioned to navigate and conquer. We've covered hooks from historical echoes to expert alarms, triggers like inflation and bubbles, impacts on stocks and real estate, and strategies for preparation and survival. The clash isn't inevitable doom. It's a reset where the prepared prosper. If this video helped you, make sure to like it. It really supports the channel. Subscribe for more videos like this and share it with someone who'd benefit. Thanks for watching. See you in the next one.